Okay.
Hi, hello, good evening, friends. Welcome one and all to Super 25 2.0, India's largest online stock traders conference. Friends, today we are in the seventh session of the 25 seminar series. We have an interesting speaker, Mr. Joy Mukherjee. He is the founder of OTP Academy, a technical analyst and a directional F&O trader. Has close to 10 years in the financial markets. He has trained more than 500 students on his OTP concept. Okay, you can find him in Twitter as Joy Mukherjee. Well, Joy, it's a great joy to have you as a speaker in this program. On behalf of everyone, I extend my warm welcome into the event today.
Thank you, Ashok, and welcome everyone in today's session. So, guys, here we will learn the option strategies. Today's topic is option strategies, and we will learn something regarding these strategies, how we can create, how we can manage, and how we can adjust them, along with the few technical applications with few technical charts. Okay, so it will be, I hope it will be an interactive session. So let's start. So guys, mostly we are traders and we love to trade in options, right? Options are the most attractive part of trading, that we love to buy options. Mostly the retailers are very much keen to buy options because it needs a very small amount of investment. The margin is very small if we compare with option selling or futures trading. And there are many people who are interested in option selling or option strategies as well. So most of us are trading with options in particular segment, and our job is to make profit. It doesn't mean that we will make profit in each and every trade, right? There could be some negative trades, there could have some market risk, there will be some market risk. So we should not expect that each and every trade will go for profit. Few will be bad decision or due to emotions, few will be negative. So what shall we do? Before taking to the strategies, I must inform or I must discuss about the risk reward. I hope you follow risk reward ratio properly, and I hope most of the speakers are also informed or they have also discussed about it. But still, I would like to take few minutes regarding the risk reward ratio. So guys, please at least keep 1:2 risk reward ratio. Otherwise, it will be very difficult to survive in stock market, in trading in long run. So keep your risk reward ratio 1:2. It means if you are taking risk of 1 rupee, 1 point, then your reward should be 2 points or higher. That could be 1:3, 1:4, 1:5, whatever, but not less than 1:2. So that is the basic requirement. That is the trading principle that we cannot break, never. Okay, so I hope it is very basic, and I hope it is clear to you, because it is very basic discussion, very basic understanding that we have to keep our risk reward ratios in a healthy way, and so that we will never fall in strategic problem in our trading. So even if we follow the risk reward ratios blindly, then also our half of the job is done. Rest comes your strategies, your analysis and all. So risk reward ratio and position sizing, these two things are very important. please do follow both of them. Position sizing means you need to calculate properly how much quantity you should buy or how much lots you should buy or sell. So these two are very important. I'm not going in depth. I hope these are very basic, and I hope these are very much clear to you all. If you have any doubt, you can raise your question here, so I will go in further detail. Otherwise, better I go for the strategies or I go for the options directly, because this today's topic is options, not the risk reward ratio, but still I'm talking about it because this is the first point that I have to talk. I have to discuss about it before taking any class. If I'm not discussing about it, it means that class is incomplete, that session is incomplete. So that is the reason why I'm talking about it. Okay, so I hope it is clear to all. So let's start with our options. So here also I will assume you all are basic and you all are freshers. You all need basic knowledge as well. So let me start with the first part of option, that we have two types of options: call options, put options, and all these options are divided into three types, that is in the money, at the money, and out of the money. What is in the money? If you are buying, for example, Nifty is trading at 12,000, just for example, assume, then if you are buying 12,000 call or 12,000 put, then it is at the money, same strike price where your particular underlying asset or the index is trading. If you are buying at the same level strike price, then it is at the money. Fine. If you are buying in higher strike prices like 12,100 or 200 for put options, that is in the money. For call options, lower strike prices are in the money. So we have to understand that in the money we have intrinsic value, but for ATM and OTM, at the money and out of the money options, we don't have any intrinsic value, only time value is there. So time value will decay every day, every hour, every minute. So when we are trying to create strategies, mostly we will be used ATM or OTM options, because we need to eat the time value. In the money options will have intrinsic value. So the problem is intrinsic value will never decay. So if we are paying any margin, then I will go for the 100% time value. I will go for those options. I will try to identify those strike prices where I have 100% time value in the option premium. So words, at the money, in the money, out of the money. Three types of options are available. Fine. Now your options are option prices or the premium. They are very much dependent on IV, implied volatility. I hope you have heard about implied volatility. So what is implied volatility? Implied volatility represents the expected volatility of a stock over the life of the option. So life of the option means what? Life of the option, it means up to the expiry. If you are buying this monthly contract, then the expiry is on 27th. So up to that day, how much volatility is expected by market participants? That is IV. So what is the volatility? When volatility may rise? When this volatility may fall? What do you think, guys? So what will happen?
Joy, can you please make the slide as full slide, like a slideshow?
Yeah, definitely.
Thanks.
So if we see there, Ashok, where is that option?
Just right bottom below the Super 25 logo that is there. Not that. On his little that one. No, next one. Right side. Yeah, one more right. Not that.
Okay, got it.
No. Escape it. Escape it. The one next to it. That one. Slideshow.
Okay.
Yeah, perfect.
Okay, got it. So we were talking about the IV. So if we are expecting market to fall, if we are expecting some corrections are possible in market, so what happens? Risk will increase. If market is falling, fear in mind, it will increase. So the volatility will increase. So always remember, most of the time your IV of a stock or any index, it will rise if market falls. At the same time, if market rise, normally everything is fine, everything is good, only good news is there. So volatility is in control or it will fall. Volatility or IV will fall. So how it will affect us? Because if IV is rising, then what will happen? Your risk is rising. So if the risk is rising, then option sellers will never be ready, or they will not agree to sell options at the same price, because market may fall more than the expected or more than the normal range or the current range. So for that they need extra premium. So if IV is rising, option premium will be costly, and at the same time, if IV is falling, your option premium, it will fall, it will be low. So if IV is low, premium will be low. If IV is high, your option premium will be high. So at that point, how to calculate whether my IV is high or no? Normally what I do, I try to buy options. Buy options means I'm not talking about buy naked options. Option buying strategies. So I try to buy options when the IV is 30 or below. The IV level is below 30. That is the better time to create option buying strategies. At the same time, if IV is above 70, that should be the best time to sell strategies, to create the sales strategies or to sell the options. Because high IV means premiums are high, so your reward will be high. But what if you sell or if you create short positions or in option strategies, if you create the sell strategies when IV is below 30, then premium is very low, time value is very low, your reward will be very low. Exactly. So we need to trade as per the IV. Now there is another condition, that is there are many stocks available at F&O. For example, Infosys, HDFC, Reliance, and in another side, Indiabulls Housing Finance, your 𝐬𝐮𝐬𝐭𝐈, these type of stocks. Can we compare them? Obviously no, because both the stocks are not same. Both the stocks are not in same standard, not in same sector, not in same category. So we cannot compare HDFC's IV with 𝐬𝐮𝐬𝐭𝐈. We cannot compare Infosys IV with Indiabulls Housing Finance. I'm not saying those companies are bad or those companies having some I have some any personal choice. No, but it depends on the market participants. They have created the IV. They have agreed to trade at higher IV because they feel the uncertainty is high on that